Scotch tape, 3M. Johnson & Johnson, baby shampoo. Old Spice deodorant, Procter & Gamble. Listerine mouthwash, Johnson & Johnson. Dove, soap, deodorants, Unilever. Toothpaste, Colgate. Pampers, baby wipes, Procter & Gamble. If you have kids or maybe you're going on vacation, you don't trust the TP there. What do all these items have in common? Yeah, you may have a lot of them in your house, but they also are all made by companies that pay dividends. So today we're going to talk about dividends. My challenge to you is to go out and spend at least a portion of the money you spend buying all these products or other products you may have in your home on buying stock in that company so that you can take part in the profits through dividends. What's going on, money lovers? Welcome back. So today I want to talk to you about dividend investing, and this is probably the easiest, most foolproof way to get rich. I'm going to talk about many of the benefits and also a couple of the risks. And this in many ways I like even more than the index fund approach. So lately, I feel like I've been doing a little too much speculating, focusing too much on, companies that at the end of the day are a gamble. They can go either way. They're either going to, 100 or 0. And as you can see, the market in volatile times, these speculative companies are the first ones to get absolutely demolished. And that's what we've been seeing happen, while the safer companies, the ones that have been around a long time, have been doing fine. So while the entire market is actually not down that much, the speculative companies are down tremendously. So by investing through dividends, you give yourself peace of mind, you give yourself passive, consistent income, and it can even make you a millionaire. So today I'm going to talk about a couple things you should know about dividends and give you some examples. So let's get started. So first, really quick, if you don't know what dividends are, it's money that is paid out to shareholders for owning stock. So let's just say, for example, you own one Apple share, and let's say Apple is trading at $100 and it pays a dividend yield of 0.68%. That just means you get 68 cents a year for every Apple share you own. I'm going to get to what all these other numbers mean here with the 5-year compound annual growth rate. We're going to plug all this into a dividend calculator, and you'll understand why it's all important in a few minutes. So I took 10 stocks here that pay dividends. I try to, diversify it. Some of these are companies I own. Some of them are companies I don't, but I would like to own. So we've got Apple, Microsoft, some tech plays, Johnson & Johnson and AbbVie are healthcare companies. Procter & Gamble is a mishmash of things. Starbucks, PepsiCo, JP Morgan, banking. Realty Income is a real estate investment trust. And IBM is another fun tech play I threw in. So as you can see, they have drastically different yields or dividend yields. So this is the amount of money that they pay out to shareholders. So for each share you own, you're getting that percentage in dividend payments. So like I said, let's say IBM is if it's $100 a share, they would pay out a $4.78 dividend each year. Most are paid quarterly. I went ahead here and I did the average for you, which comes out to 2.68%. And you're probably thinking to yourself, how can I possibly get rich and become a millionaire with only 2.68% annual yield? Well, let's look a little closer. So for example here, the 5-year CAGR, compound annual growth rate, is the average that a company is growing their dividend per year. So on average, over the past 5 years, Apple has grown their dividend almost 10%. Same with Microsoft, around 10%. AbbVie has grown their dividend 20% on average. Some of these other companies are very high and some are very low. Generally speaking, the companies that have been around longer will have a lower CAGR because they're already paying out a significant amount of money in dividends, whereas a new company or a company that has newly declared a dividend is going to have a lower rate and probably a higher compound annual growth rate because they're still growing their dividend. So that's why you see Apple, it's only 0.68%, but they're growing at 10% a year. Versus Realty Income, company that's been paying a dividend forever, they're only increasing it a little under 4% a year. Now, as far as if these are companies I own, you can see here, I do own Apple, Microsoft, J&J. I do not own AbbVie anymore. Kind of regret selling it. Might have to get back in. We'll see. And I really didn't have a good reason for selling it other than I wanted money for other more speculative plays. I do not own Procter & Gamble, but I think I'm going to be buying it soon. I own Starbucks. I want PepsiCo. I do not own JP Morgan. And I own Realty Income and IBM. I'm going to give you guys an example and you can see how this is going to work here. So we're going to plug these numbers into a dividend calculator. And I'm going to put links in the description for where you can get information on dividends and how to calculate this on your own as well. So you could apply it to your own portfolio and give you some sort of idea of what you can expect. Let's just say that you were starting with $10,000 and you were going to allocate $1,000 to each of the companies I listed here. So your average dividend annual yield would be 2.68%. And let's just say annually you're going to add another $20,000 to the account. As you make money, you're going to average in every month, and your expected annual dividend increase, if we're going off those companies I listed, their average annual increase, we said, was almost 10%, a little lower. For now, I'm just going to say no taxes. I'll plug it in later to give you a better picture, but just to keep it simple, your distribution frequency is usually going to be quarterly, meaning a company pays out its dividend quarterly. Now, it's not going to pay the full dividend quarterly. It pays that annually, so you have to think you're getting a fourth of that. So if it's $4, you're getting $1 each quarter. Now, let's just say you can expect the stocks are going to appreciate about 10% annually. That's roughly what the S&P 500 does. And then we've got our DRIP turned on here, which means you're going to reinvest your dividends. It's a dividend reinvestment plan. So after 5 years of being invested, let's see how much dividend income you'd be taking home. At this rate, you'd be taking home $6,500. Okay, not bad. That's about the amount of money you're probably making with a side hustle. Now let's see after 10 years. So after 10 years, if you kept investing like this, you would be taking home over $30,000 annually in dividend income alone. That is more money than you could probably make from a side hustle, a part-time job, and you're doing this from the comfort of your home, sleeping every night. You don't need to do any extra work. You just need to buy these dividend stocks, and your yield on cost is already up to 15%. So think about this as money in your bank is probably getting 0.02% right now, or somewhere around there. You would be getting 15% yield on your money. Now let's jump to 20 years. After being invested at 20 years, following this, contributing each year, annually, you would be taking in over $700,000 in dividend income. Now, I'm just going to change a few things here. Up the contribution rate, $30,000 a year. Up the dividend yield, 5%, which is very feasible. There's a lot of higher yielding dividend stocks out there, much higher than the ones I picked today. Just to name a few. Altria probably has about a 7% dividend yield. So if after 15 years of us investing 30 grand a year at 5% dividend yield and an expected annual increase of 10% to those dividends, you would end up with $656,000 in dividend income. And after 20 years, you would be getting $5.6 million a year in dividends, just in dividends alone. Now, if we turn on the tax rate here, just to give you a more accurate picture, figure you're going to pay 15% tax rate on long-term dividends. That only brings the number down to 4.1 million. So not bad. You're still way ahead of the game. Next, I just want to go over some benefits and some risks associated with being a dividend investor. Some benefits, you're getting consistency. Generally speaking, if a company is in good financial shape and they are a company that's well structured, devote money to R&D, they are going to pay those dividends in tough times and in good times. Very rarely you see a company cut its dividend that you couldn't see it coming. You know, there's companies that take on a ton of debt, and then it makes sense they can't afford to pay the dividend. Business is not booming. But generally speaking, investing in dividend-paying companies is a very consistent and reliable source of income. And that's the other thing. It gives you an income, a consistent cash flow. You're getting these dividends monthly, quarterly, annually. You can depend on them versus buying a stock and hoping it goes up. It's not a reliable or consistent way to go about investing. So you don't need to worry about market volatility with this. Because, as I said earlier, speculative stocks get hit the hardest as soon as there's any uncertainty in the market. But you're a dividend investor. It doesn't matter if your dividend stocks are going up or down. All that matters is that they're still paying you that dividend. And if they do go down a good amount, you could just use it as a buying opportunity. Or you can use it to reinvest those dividends and get shares for cheaper. So it eliminates, I believe, a lot of the stresses that come with buying non-dividend paying stocks. You got to figure out when I should be buying, when I should be selling. It's a lot of stresses. It's a lot to constantly worry about. Then you get mad at yourself. You sold too soon or you sold too late. You don't have to worry about any of that with dividend investing, and it gets you there. Now, one risk, some of these companies like J&J, maybe Procter & Gamble, the Amazon effect, if they start to get competition from new innovative companies, you could see them maybe disappear or lose some market share. But I think at least the way things are for the medium-term future, these companies aren't going anywhere. Even if Amazon starts to get into these spaces, there's enough room for all of them to coexist. So one risk would be innovative companies coming around that, knock out some of these older companies. Now, one last thing I want to show you guys, very interesting here. So if you had bought one share of Apple in 1987, with all the stock splits Apple has had, Apple's had about 5 stock splits in the last 33 years. One share of Apple 33 years ago would now be 56 shares. So just imagine if you had 100 shares of Apple. You now have 5,600 shares of Apple. And oh, that's great and all. You might say, why do I tell you this? If you are getting 0.68% dividend yield, like I said earlier, let's say Apple, if it's $100 a share, 68 cents a share, well, think of all the shares you now have. If you have 5,600 shares, because you had 100 shares that you held since 1987, you're getting a lot of dividend income. So those calculations I showed you are really overly conservative basement number. If you buy and hold, you'll probably end up with a lot more. And another advantage to not selling is you're going to pay a lot less in capital gains tax. If you sold all your Apple shares, you get one time that amount of money and you're going to pay a ton in taxes. Whereas with dividends, you're just going to consistently get much less, but still a lot. To me, at least, I could do $4 million a year. That would be okay with me, and never selling it. So that's dividend investing. And I want to, I've always kind of tried to, with my investing, keep it roughly. I have my 33% or so that I put in index, or about a third, another third for dividends, another third for growth or speculation. But I've definitely been neglecting my dividends, and I want to get back to that. Huge shout out to PPC Ian, awesome YouTuber. You should definitely go check him out. Let him know the investment club sent you. He is probably one of the YouTubers that I have learned the most from. He has been doing dividend investing over 20 years. Lots of great stuff. Check out his channel. And let me know what you guys think in the comments below. Do you buy dividends? What are your favorite dividend companies? Do you think dividends are a good investment or not? Or why not? Let me know in the comments below. This is Vinny from the Investment Club, and I'll see you next time.